All right, today we are going deep. We're going to break down a market strategy that's pretty sophisticated, but the idea behind it is fascinating. It's all about taking one of the most powerful forces in the market, pure fear, and turning it into a potential source of steady returns. We're talking about systematic volatility, and specifically how to harvest something called the VIX roll yield. It sounds complicated, I know, but stick with me. We're going to make it make sense. This quote right here, this is the whole game. Seriously, so many people burn so much energy and money trying to predict the next big market crash. It's basically impossible. But what if you just changed your whole approach? What if instead of buying insurance against a crash, you decided to become the insurance company? You could actually collect payments week after week just because other people are always worried a crash is just around the corner. That's the mindset shift we're exploring today. Okay, so before we can learn how to get paid for fear, we have to understand how most people try to protect themselves from it. And that brings us to maybe one of the most famous tickers in all of finance, and what, on the surface, looks like the absolute perfect insurance policy for your portfolio. So what even is the VIX? Well, first off, it's not a stock. You can't buy it. It's just a number, an index. They call it the fear index for a good reason. It basically takes the temperature of the market's anxiety. You see, when traders get nervous, they rush out to buy options on the S&P 500 to protect themselves. All that panicked buying drives up the price of those options. The VIX just measures that price, giving us this real-time gauge of fear. If the VIX is high, fear is high. If the VIX is low, everyone's feeling pretty calm. And this right here, this is its magic trick. This is the appeal. If you pull up a chart of the S&P 500 and lay the VIX over it, you'll see something amazing. Whenever the market tanks, the VIX just explodes upward. They move in opposite directions, almost like a perfect mirror image. I mean, think about it. Doesn't that sound like the ultimate hedge? If you could own something that reliably goes to the moon every time your portfolio is getting crushed, you'd feel totally protected, right? It looks like the perfect shield. So you can't buy the VIX index itself, but you can buy products that try to track it. These are things like VXX or UVXY. They're called exchange-traded products, or ETPs. The goal is super simple. You buy this thing, and when the market has its next inevitable panic attack, the value of your ETP is supposed to skyrocket, offsetting the losses in the rest of your portfolio. But, like any insurance policy, you have to pay a premium. And this is the catch. The premium here isn't a fee you pay once. It's a relentless, hidden cost that is baked right into the DNA of how these products work. And that brings us to the fundamental flaw, the gotcha in this perfect insurance. It's a structural problem that absolutely demolishes these products over the long term. And it all comes down to a market condition called contango. This is the hidden grinder that just silently chews away at their value. Okay, this is the most important part to understand. Products like VXX don't actually hold the VIX. They can't. What they hold are VIX futures contracts. Now, a futures contract is just a bet. It's a contract to buy or sell something at a set price on a future date. So VXX is constantly making bets on where the VIX will be in 30 days or 60 days. It does this by holding a portfolio of these contracts. And the price difference between the 30-day contract and the 60-day contract, well, that's everything. So the VIX futures market really only has two modes. Most of the time, something like 80% of the time, it's in what's called contango. This is the normal default state. The futures curve slopes up, meaning a VIX future for next month costs more than one for this month. And that makes sense, right? There is just more time for something crazy to happen over a longer period. The market price is in that uncertainty. Now, the opposite state is backwardation. This is panic mode. The curve flips upside down. This happens during a crash when the fear right now is way higher than the fear people expect to feel a month from now. Okay, so here's exactly where that hidden insurance premium gets paid. Let's say VXX is holding the October VIX future. As the end of October gets closer, the fund has to sell that contract and buy the November one to keep its exposure. But remember, in contango, the November contract is more expensive. So every single month, VXX is forced to sell low and buy high, sell the cheaper expiring contract, and buy the more expensive next month one. Imagine having to sell your car every month only to buy next year's model at a higher price over and over again. That constant loss is the negative roll yield. It's a bleed that's built right into the system. And really, this quote says it all. If you ever look at a long-term chart of a product like VXX or UVXY, it looks like it fell off a cliff. It's a ski slope headed straight for zero. That constant, grinding decay, that is contango. You're seeing it in action. So you have to ask yourself, if holding these products is a structurally losing proposition, who's on the other side of that trade? If someone is consistently losing money, well, someone else has to be collecting it. This is where we flip the entire script. And this is the big aha moment. For every person paying that roll yield premium, there has to be a seller who is collecting it. This isn't a flaw in the market, it's a feature. It's a systematic transfer of money from people who are desperate for crash insurance to those who are willing to sell it to them. This table just lays it all out. You've got two players in this game. On one side, the long volatility trader. They buy VXX hoping to hedge, but the usual result is that their capital just slowly bleeds away. On the other side, you have the short volatility trader. They are the ones selling those VIX futures, either directly or through special products designed to do the opposite of VXX. Their goal is simple: collect that premium. In a normal market, they just sit back and get a steady return. They are the insurance company. And that is the alpha. That's the edge. The strategy isn't about being a genius who can predict the market. It's about taking advantage of the market structure. By being short volatility, you're systematically collecting the money that panicked hedgers are willing to pay. It's almost like a cash flow strategy that profits from the simple passage of time. And it works. It works beautifully, right up until the day it catastrophically doesn't. And we have to talk about that last part, right up until the moment it doesn't, because the market isn't always calm and normal. And when it breaks, this elegant, systematic strategy can become one of the most dangerous trades you could ever put on. We have to face the brutal reality of what can happen. Now, a black swan isn't just a bad day in the market. As our sources point out, using Nassim Taleb's definition, it's something completely off the charts. It's an event nobody saw coming that has a massive impact and that everyone tries to explain away after it happens. Think about the crash of 1987 or 9/11. These are events that break all the models. This is a classic analogy for this strategy, and it's perfect. Imagine you're picking up pennies off the street. It's easy money, right? You do it all day, month after month, and your pile of pennies gets bigger and bigger. But you're doing it in the middle of a highway in front of a steamroller. It feels safe because the steamroller hasn't moved in a long time. But one day, with no warning, it lurches forward. And in that 1 second, all the pennies you've collected become completely meaningless. And this number is what that steamroller looks like. When a black swan hits, the VIX futures market can go absolutely insane, gapping up hundreds of % in minutes. A short volatility position without an escape hatch doesn't just lose some money, it can be completely annihilated. A 90% drawdown isn't an exaggeration. It's a real historical possibility for people caught on the wrong side of this. So how on earth do you survive that? Well, Taleb suggests a couple of ways, but the one that really applies here is strategy 2. You can have a speculative portfolio, but you must insure it against huge losses. For a short volatility trader, that insurance is a non-negotiable exit plan. It's a hard stop loss that says, if this trade goes against me by 15%, I am out, no questions asked. You simply cannot afford to ride out a black swan. And this quote just nails the psychology required. The biggest danger in a strategy that works 99% of the time is that you start to get overconfident. You start to think the steamroller will never move. You get attached to the trade. That's why having a mechanical, pre-planned exit strategy isn't just a good idea. It's the only thing that separates long-term survival from blowing up your account. So all of this brings us to the final critical decision. We've seen both sides of this coin, right? The steady, almost predictable income stream and the potential for a sudden, catastrophic loss. This is the ultimate investor's dilemma. Here it is, laid out as clearly as possible. On one hand, you have the powerful appeal of consistent, small gains. The math of contango is on your side most of the time. It feels good. On the other hand, you have the terrifying reality of a rare but life-altering loss. The risk isn't that you have a bad month. The risk is that one bad day erases years of your hard-earned gains. Your entire success hinges on your ability to survive that one bad day. And so that is the question I'm going to leave you with. This strategy gives you a systematic way to profit from the market's constant state of anxiety. But it demands absolute, ironclad discipline and a massive respect for that steamroller. So the question you have to ask yourself is the reward of harvesting fear worth the ever-present risk of being completely consumed by it? Thanks for tuning in.